thank you everybody for joining us here today. Good afternoon or good morning, wherever you may be located. Hopefully you're warm. It's quite a bit of cold weather throughout the country. So hopefully you're not stuck in that like many of us are. As Tony said, this is the first installment of 2025 for our Originate More series. This is a monthly webinar series that we do for any broker or loan officer throughout the country. We hope to give folks tips or knowledge on how to just in fact do that, originate more loans. We try to keep them informative. We promise never to bore you with matrices, and hopefully you'll all walk away with some knowledge or tidbit that'll help you in fact originate more loans. As Tony mentioned, today we'll touch on bridge loans for primary residences, or what we call our Bridge Star product. And the essence of this program is basically you've got a homeowner, may have been in the house for quite some time, they've got a substantial amount of equity. Generally, it's a move up situation. Sometimes it's a move down. There's a few things going on there. They may need the equity in that current house for the down payment. There may be qualification issues, et cetera, et cetera. So we'll touch on some of those things. This is really a great program for borrowers that you deal with to give them more options to in fact get into their new home. And it's really a great program to help you as a loan originator, win more realtor business. Many realtors, of course, have interest in bridge loans. So we'll get started. Again, my name is Jamie Gilso, joined with Jackie Weed, who oversees all of ops, underwriting, and exceptions for our TPO channel. Quick agenda, we'll just a couple slides on who we are and what we do. Why you may want to partner with us. We'll do a quick overview of the 25 housing market, which looks favorable. Talk about how the bridge loan can help you alleviate some concerns in that housing market and win more business. Show you a couple actual deals we've funded with this product. And as Tony mentioned, we'll try to answer any questions you may have throughout or after the presentation. So who are we at American Heritage Lending? We are a full service nationwide non-QM lender, established in 2008, been around quite a while. Corporate office in Irvine, California. Operations focused throughout the US, so we're covered in all time zones. And the management team has a long history, as Tony mentioned, in non-agency and non-QM lending, going back many decades. So we're very comfortable when it comes to non-QM. This is not something we started doing 14 months ago. I think you'll see that evidenced by not just our product offerings, but by our ability to make common sense exceptions. We are a lender that you can trust. As I mentioned, we have a great staff of seasoned non-QM professionals. We're very big on culture and family. So there's a picture of some great folks, all of our folks for the most part. Very flexible underwriting. Again, 38 to 41% of our business each month is some kind of exception to our own guidelines. Got seasoned account executives and inside staff that can help you structure loans. So please reach out if you need help, if you have questions. Full suite of non-QM products, all kinds of non-QM products with certain wrinkles or niches. Please reach out to your account executive for more information, but bank statement loans with ratios as low as 10 or 20%. DSCR, where we can use the 1007 over the lease when beneficial. We can go up to 85 LTV, foreign nationals of 75. Very wide array of condo and condo tel offerings, and so on and so forth. We are licensed in some degree in 48 states. Business purpose only loans in New York, Hawaii, Alaska, and Missouri. You can see on this map. This is available on ahlendtpo.com if you need to reference any of this. One of the few true non-QM lenders with a full license in the great state of Massachusetts. Go Red Sox. We'll see. Sorry, Yankee fans. All right, so why would you partner with American Heritage Lending? Again, we have a full suite of non-QM products with many wrinkles and niches, one of which you'll see here today. Very common sense underwriting. User-friendly portal. We probably have one of the better portals in non-QM. That's what our customers tell us. It's very intuitive. You can upload your loan, get your bank statements reviewed. You can disclose, lock right there with a few buttons. We offer delivery across all channels, wholesale, correspondent, both delegated and non-delegated. We actually have some table funding options as well. We feel we have best-in-class turn times for non-QM. Majority of our loans are in and out in 20 days or less. So the bridge loan and what opportunity presents in the housing market where you can use it? Well, here's some stats from folks like Redfin and NAR and Zillow. And while they all differ a bit, you can see that all three feel that there'll be somewhere in the low to mid 4.5 million or 4 million homes sold in 2025. So Plenty of real estate action this year. We joke around here, there's always a loan. So one of the things that you will see, we see happening more and more, you can see some commentary here from Mr. Yoon, the chief economist at NAR, is the lockup piece or the locked in piece from low rates is starting to subside. The reality is life happens. So regardless of your mortgage rate, you may have another child and may need an extra bedroom. Regardless of your mortgage rate, you may have been relocated for your job. Regardless of your mortgage rate, unfortunately, you may have a divorce situation. So there'll always be a loan. There's always a need for a mortgage, and we'll see more and more of that happen in 25. You can see that we expect, or economists expect, I should say, I'm not one by any means, I'm a mortgage person. Existing home sales rise 9% year over year. New home sales, of course, will jump as inventory can be built. And sales prices, as we know, on everything, it seems these days, tend to go up. So that presents, while opportunity, right? 4.5 million home sales, higher loan sizes, new construction, all exciting opportunities. With that can come some challenges that all of us on this call face together on a regular basis. Home buyers may need to tap into their current home's equity for the new purchase. Many people don't just have the extra money sitting around for a healthy down payment on a new house. Of course, time and qualification matters. Can they carry both debt ratios if needed to qualify for the new home? And we all know that in many markets, based on today's inventory levels, most realtors or sellers do not want to entertain offers with contingencies. So they don't want to wait till your current house sells, or they don't want to wait till you can qualify for the mortgage. They want to offer now that is fairly strong with no contingencies, so they can close hopefully within 30 days. So the solution to a lot of those challenges is, in fact, our Bridge Star loan, as we call it, which again is a bridge loan for primary residences. Great solution for all the things we just mentioned. Hot markets where offers without contingencies matter. New construction where even if the current home could sell quickly or the borrower could move quickly, the new home isn't ready. Homeowners that are equity rich but may not have a lot of cash at their hands for down payments. If you have solutions to these things, of course, you can originate more loans by naturally partnering with folks like realtors, but also don't forget home builders and developers. We see these leads come in from our partners, from folks with financial advisors and CPAs. Many folks, based on where they are on their website, are going to the financial advisor for help on some of these situations if they've got substantial equity but not enough cash. The financial advisor may caution them against a big tax burden by cashing in investments for a down payment when they could probably utilize the equity in the current house, which in some cases may actually be a tax benefit for the interest accrued. So our bridge loan is very unique, we're happy to say, and we offer it both as a standalone loan program or as a two-loan solution where we do a bridge as well as the purchase on the new house. So on the standalone program, we're up to 70 LTV. We're going to give the cash out needed towards the new purchase. That loan is on the departing residence only. So if the borrower qualifies for a Fannie or Freddie or conventional loan, you can, of course, go take them that route. Or maybe there's enough equity in the current home and they're downsizing and the new purchase will be cash. That's fine too. But it's a standalone program, we're happy to say. And then we have a simultaneous as well, where we actually go up to 75 LTV. What's nice about that is if we do in fact do the purchase loan on the new house, we go up to 90 LTV on the new purchase, and we take the payment from the prior house out of the debt ratio. So they can really qualify for max buying power, in terms of not only down payment, but cash flow and DTI. Opens up a lot of capabilities for your borrowers. Also, based on the terms of this loan, which we'll go over in a second, really frees up their cash flow during the transition. If you've ever bought and sold a house, there's a lot going on there. There's moving trucks, there's U-Haul folks, there's utilities, etc. Cash gets a little interesting during that time frame. So to have favorable terms on the bridge can certainly help. So let's talk about that for a second. This bridge loan, again, is on the departing residence. That departing residence must be listed Again, the spirit of this loan is they are in fact selling that house to either move up or move down. We do allow all income types on that bridge loan as well as the acquisition loan. So full doc, bank statements, asset depletion, 1099, P&L, or a combination thereof is fine. What's nice about this loan is the bridge loan is a 12-month term. It's an interest-only loan, and the payments are deferred during that term. So your borrower has no cash flow pain again during that transitional period. If they take out the bridge loan today, they close on the new house right away, and there's a 3 or 4 month process while they get moved in, sell the current home. During that time frame, there's no payment on that departing bridge. So really, again, gives them some peace of mind and some latitude during the move. As you can see, loan amounts range on the bridge loan from 100,000 up to 2 million. This is a TRID-based loan, by the way. Okay, so it's a TRID-based loan. If you're using the bridge on a 2-loan solution or even as a standalone, you need to consider things like rescission period for funding. So you'll need your few days in there. But we do offer it in all states where you're licensed except Texas, where it's not allowed. There is no DTI calculation on this bridge loan as well. So it's really a nice loan for anybody that's actively looking to get out of a current home and into a new house. Again, this is a great door opener for the originators on this call to use with their realtors. Opens up a lot of options, whether it's builders, realtors, etc. So now I'm going to ask Jackie, who knows a lot more of the technical stuff than I do, just to go over a couple actual scenarios where people have used the bridge loan and utilized us as well for the purchase of the new house. So I'll flip it to Jackie.
Thanks, Jamie. Hello, everyone. So we're going to review a few of the loans that we've recently done for some of our broker partners. This first one was a single family. The property value was 1.5 million. The bridge loan amount was 355,000. Of course, that's a pretty low loan to value. The purchase property, so we did the financing for the acquiring property as well. So it was a 24-month business bank statement loan. The purchase price of the new property was $1,549,000. We did a loan amount of $1,270,180 at 80 LTV. We also stacked the points on that, and we'll let Jamie kind of talk a little bit about stacking in that scenario with a FICO score of 691. So the bridge loan payment, which was $4,000, is not used in the calculation of the debt ratio on the acquiring property. So that allowed the borrower to qualify without worrying about that payment. And Jamie, you might want to just touch on the stacking for the points on the acquiring property.
Yeah, thanks, Jackie. Great point. No pun intended, believe it or not. So we have a unique feature here called stacking. We actually allow you to finance or stack up to 3 points on most loans on top of the original loan amount. And even though the loan amount goes up and the LTV goes up, your pricing stays the same. And those 3 points can be used for one of 3 things: your broker fee and or lender discount fee and or the realtor fee, which is interesting based on the recent NAR ruling. So in the example here that you see, and this is really great, talk about helping the borrower and being creative, helped them out with the bridge loan up front, gave them the cash out to put towards the new house. We're able to qualify on the new house with bank statements because we excluded the payment of $4,000 from the debt ratio. So there's another big help. To Jackie's point, pun this time intended, you can see the broker stacked 2.5 points. The broker fee on that purchase, on that $1.5 million purchase, was 2.5 points. Rather than have the borrower bring those 2.5 points to the table or take it out of proceeds, we stacked it or added it to the loan amount. In this case, it brought the LTV to roughly 82 and change. That being said, we kept the pricing at 80 LTV. So that's the beauty of stacking. You can stack up to 3 points to be used for broker fee and or lender discount and or realtor fee. That itself is a wonderful advantage to offer your borrowers, or at least option, but the pricing stays at the original loan amount. So again, if you're looking to get into the realtor game and grow your realtor business, some of these options are really unique. They'll help you stand out from your competition. We know that Bank of America LOs can't offer stacking or bridge loans like this. We know that loan officers from JPM can't either. So some real nice options here. Thanks for pointing it out, Jackie.
Amy, I have a question for you that came about on this particular slide. And the
Sure.
question was, on this funded loan scenario that we're sharing, is what is the existing loan amount on the departing residents?
No, I want to say, based on the math, the departing residence is probably free and clear.
If it were not free and clear, we would pay off that first mortgage and include that, which then, of course, eliminates the payment from the debt ratio on the acquiring property.
Yep. Okay. Scenario number 2.
Okay. So this particular scenario was a property value of $812,000, a loan amount of $600,000 for just under 74 loan to value. And the borrower was purchasing an owner-occupied condo, downsizing. The purchase price was $590,000. The loan amount on the acquiring property was $400,000. So we had a just under 68 loan to value, 804 FICO score. Again, the bridge loan payment is not included in the debt ratio for the acquiring property. And this particular loan was an asset qualifier loan. So that is where we use the borrower's assets to qualify. Our program is just a little bit different than most others, where we use the usable assets, divide them by 60 months, and then use that dollar amount for their income to calculate a debt ratio, which is a little bit more beneficial to the borrower. So of course, the bridge loan payment of $57.65 was excluded from that debt ratio calculation, and the borrower qualified with no challenges on the acquiring property.
Yep.
There's a question also came up about pertains to these as 2 questions real quickly. Do you need to do both loans?
No, we can do just the bridge if that's all you need, or we can do both.
Mm-hmm.
Okay. Second question specifically came about was regarding the stacking. So let me ask that question. It says, do you allow stacking fees on other loan programs not related to bridge loans?
Yes, stacking fees is available on really all of our products with the exception of DSCR below 1%, loans over $3 million, and the actual bridge loan, the front piece itself. Other than that, it's available on all of our products. There are some LTV caps. But if you reach out to your account executive, they can walk you through it, as well as on our webpage, ahlentpo.com. There's a copy of our stacking matrix, which spells it out as well.
Okay, I have another question. We might need to go up to the previous slide. We'll make sure when I ask this rather. It says here, where are you getting the $5,765 amount from? Payment to what? It mentioned the bridge's interest only. That seems like a high payment. So it might be, was that this slide or was it the previous slide?
No, that would be this. So the pricing on the bridge loan on a simultaneous solution is a 9.25% rate. So without running the math, potentially maybe that rate is equaling that. I'd have to do it, do the math by hand. I don't have it in front of me. I apologize. But to answer the question, the number we're showing here is meant to reflect the bridge payment being excluded. So if the math is off, I apologize.
Okay. Another question that came about is, what's the maximum origination amount that can be charged on the bridge?
Great question. So the bridge, we recently switched it to an ARM-based product, 12-month ARM. The pricing on a standalone is a 9.75 rate at a cost of 2.5 points because it's short-term financing. The pricing as a simultaneous loan is 9.25 at 2 points. So the amount the broker can make will vary based on the loan size. Obviously, your APR and high costs kick in a little quicker at that pricing. The ARM structure does help, but a $1.5 million loan will have more ability to earn on the bridge than say a $150,000 bridge loan. If you want, Tony, if we can capture the email information, we can send folks some rough examples of what roughly a bridge loan a broker could make at say 500,000, 800,000, et cetera, just so they have some ranges.
Absolutely, absolutely. And Jamie, is there a payoff penalty period?
Not on the bridge. There's no, again, the essence of the loan is this is a short-term loan. It's usually paid off in 6 to 9 months once the borrower has moved and sold the existing house.
Okay. And then for either the bridge program scenarios, must the borrower have acquiring property under agreement? I believe that was
Yes.
answered. Yes.
The proceeds from the bridge have to be used towards that new purchase. We allow the proceeds from the bridge have to be allocated towards the purchase of the new home and/or reserve requirements and/or debt paid down to qualify. The max cash in hand outside of those things is $5,000.
Okay. This question.
I'm sorry, Tony, we do wire those funds directly to the settlement agent that will be handling the acquiring property, regardless of whether we're doing the financing on it or you're doing some sort of agency financing on the acquiring property.
Great point. Thank you.
Now, this question is specifically to scenario number 2. Says, can you help us understand? So they take out a bridge loan for $600,000, buy a property for $590, but still taking another loan for $400? ?
So there was a first mortgage that was paid off with that bridge loan. So there was an existing lien on the departing residence that was paid off. And then the borrower also received cash for the down payment on their new property.
Perfect. Next question is, borrower is selling this house because buying a new house. Borrower is selling his house because buying a new construction house. And it will be ready, let's say September of 25. If he realized that he might not sell on time and a bridge loan, can he still qualify with the building's lender?
With the, I'm sorry, qualify with?
Here, I will rephrase this. Borrower is selling his house because buying a new construction, and the house will be ready September of 2025. If he realizes that this might not sell on time, and with the bridge loan, can he still qualify the builder's lender?
My guess is, well, a couple things. The builder's lender, if they're giving a mortgage on the new property, it'll be their guidelines that'll dictate, whether or not they're going to include the bridge loan in the payment. So if that's the concern, they probably would have to check with the builder's lender in that case, unless I'm misunderstanding it. Jackie, you've seen something different?
Yeah, no, that would be exactly correct, Jamie.
Okay. Let's see here. One was asking, which we can certainly follow up because I have contact information, as you mentioned, Jamie, as there were just a couple inquiring about the full breakdown, payoffs, etc., to make these scenarios more helpful. So sure. Yes, this individual that asked, I have your contact information. We can certainly give you some more scenarios and some recently funded details with those. So to break it down a little bit more detail, that'll certainly help. So we can certainly supply those, as you mentioned. Let's see here. Okay, just to clarify one last particular item. So just sure. Question. Do not understand that the bridge loan payment is not being used, but they are still qualifying with their current mortgage payment.
No.
Correct. No. Okay.
So the existing mortgage on the departing residence would be paid off by the bridge loan, and then that entire bridge loan payment is excluded from the debt ratio on the acquiring property on our programs.
Okay. Okay, let's see here. What are the terms of a bridge loan? For instance, if you can discuss rate, can we make comp on the bridge, compensation on the bridge, etc.?
Yes. So the pricing on a standalone bridge, if we're not doing the second loan, is $975 on a 12-month arm, interest only, and 2.5 points. The pricing on a simultaneous bridge, if we're doing both loans, is $925 on a 12-month arm, interest only, and 2 points. Again, it's short-term money, so there's not a lot of profit in a 3 or 6 or 9 or 12-month loan. What we're really selling here is the solution, the solution to the borrower to be able to get into the new home, the solution to the realtor to get more business. But the ability, or the broker can make money on the bridge. How much the broker can make really varies by the high cost calculations, which of course vary by the loan size. So the higher the loan size, theoretically, the more the broker could make. We will forward some examples at different loan sizes to the attendees as to what that can look like.
Okay. And I think we might address this just to make sure we answer this question. It says, we know that I believe the answer to the first part in that if there is a first mortgage that needs to be paid off, is the compensation on the full bridge loan amount or just the cash out amount?
Full bridge.
Okay, perfect. Can proceeds be at all leveraged towards debt payoff to qualify for acquiring property mortgage?
Yes, but we will want payoff statements. Need to be legitimate payoffs, even if they're credit cards. We'll want to be able to, tie those dollars to a payoff to keep that cash in hand at 5,000 or less.
Okay. Let's see here. Give me just a moment. I'm looking to see if this is this particular slide or the previous one. The 190,000 down came from other sources. 75% bridge would be 690, which would pay off the 600,000, leave 9,000 left. Is that correct?
I don't think so on this loan. You've got an 812 property. It's a 600K loan. So we know that they put 190 down. So you would take 190 from the 600. So you're at about 410. So my guess is they had an existing lien of around 400,000 or so that was paid off. And then we added the 190 down payment on top of that. And that came up with a $600,000 bridge loan amount.
Okay, and that's what the rest of the question was. If this is true, the benefit on this is not getting cash to put down on the new one, but being able to exclude DTI from over 600K in debt.
Both, and that's a great question, because the benefit, it could be either or both of those, right? Some people need the equity for the cash down. Some people might have the cash down but can't carry both payments. And of course, some people need both.
Okay. Okay, that makes sense. Thank you. Let's see here. Does one have to be licensed for bridge loans?
Yes, this is a TRID loan. So full licensing is required, full disclosures, 3-day rescission on the bridge, etc.
Okay. Let me see. This was just a follow-up to the earlier one, and if you need me, let me know. It says, okay, on the other lender, may not approve the loan because the client has another loan. Is that something to be concerned with?
Sure. Again, we can't speak to the lender's guidelines. Every lender is different. Some may let you take the bridge loan out of the debt ratio if the house is under contract. Some may not. I would say the good news is, if for some reason, in this case, if we use the scenario of the builder's lender, if they will not accept or take that bridge term out of the debt ratio, then we can help with that loan. Because we will take it out of the debt ratio and still give them up to 90 LTV. So there should be a solution for them either way.
All right. Let's see. Is the bridge loan always paying off that existing mortgage, or does it ever act as a second?
No, it always takes first position. It'll always pay off the current existing mortgage.
Okay, thank you. Let's see here, following that, this is a follow-up, but if the purchase mortgage is with another lender, then most likely the lender will count the bridge loan payment into their DTI. Is that correct?
Again, I don't want to speak for that. I've seen some lenders on the agency side where if the current house is under contract, they would not count that mortgage towards the new home. But every lender, has their own different overlays and guidelines on how they look at that.
Okay, let's see here. We have, let's see here. This is one, let's see. This might have been asked or answered, but can you pay credit cards, etc., debt at closing to qualify?
You can, but we will want to see payoffs included.
Payoffs.
Yep.
Okay.
We restrict the disbursement, so we actually have title disperse those funds.
Okay, thank you. So Fannie Freddie does allow excluding the departing bridge loan from the new acquisition DTI ratios. Says, I guess the benefit of doing both loans with AHL is the better bridge loan terms, maybe 9.75, 2.5 points versus maybe 9.5 at 2 points.
It can be, and again, every situation is so different. What's the resulting down payment on the new house? We're 90 LTV, no MI. Well, what if it's 90 LTV with MI? What's that payment look like? What if there's an LLPA for a multi or multi-family in there or something? So, again, the benefit can vary based on the scenario. Like, let's look at this scenario that's still on the screen. So, we're doing a great job, and this is probably some of the best questions we've had in a webinar. So thank you to the group. But, we're talking about the benefit here of the cash out towards the down payment. We're talking about the benefit here of excluding that payment of $5,700 or whatever it may be from the mortgage to qualify. But let's look at the complexion of this borrower. Again, remember, the essence of these webinars that we hope to see you for a month is to try to help you originate more. By doing that, you find some non-traditional avenues of business. They can lead to referrals. So let's look at this borrower. They've got a substantial asset base because they went asset qualifier. They have substantial equity. They're buying a condo and they're downsizing. That could be any one of ours grandparents or parents, right? Successful person, had a house for a long time, don't need it anymore. I've got assets, I've got equity, I've done everything right in life. But, maybe my Social Security, et cetera, I don't qualify for the downsize. So in addition to helping with the DTI calc, and in addition to helping with the down payment, think of that borrower and the help that you're giving that borrower. And then where could you now originate more of those loans? Financial planners are helping these folks. Homes in 55 plus communities these folks are buying. So now you can take some of these nuggets and go find and source and originate more of this business. So the solution with the bridge really will vary based on the scenario, and the benefit could be multi-layered as it is in this one.
Okay, perfect. Let's see here real quickly. This is just, and I do apologize, I've kind of changed the questions so they're in order, not as how they're coming in, but by asker. So maybe we can keep the flow of these questions for,
This is great.
as a follow-up. One looks like a last follow-up question. What we discussed was, but if the loan is under contract, why would they need the bridge?
So again, if the current home is under contract, not just listed, but under contract, they may be able to qualify as it is for the new house, fine. But they may need help with the equity. Maybe if they need equity for the down payment, they can't qualify for the HELOC. We see all variations of how this program is utilized. And then ultimately, I don't want to talk us out of a loan, but maybe they don't need a bridge loan. Maybe they're that well qualified, and that's cool too. That's awesome too. But somebody will need it at some point, and that's where we can help.
Or maybe they're the acquiring property they're going in to purchase for cash, or they need a quick closing that needs to happen before the departing residence settles. So, there's a myriad of reasons.
Great points. Great points. Thank you.
All right. Let's see. And now, does the bridge have to close simultaneously with the new primary?
No.
The bridge, well, it will close, a few days before the acquiring primary. So because we then wire the funds directly to the settlement agent for the acquiring. So you can get your approval, and then, we kind of hold it and pend until the borrower has a closing date on the acquiring property.
Okay, and how quickly can we close a bridge loan?
Well, we can close loans in 10 days or less. So as quickly as you can help us get it closed.
I agree. Yeah, that makes sense. Let's see here. Let me see here. Specific question, how are rates compared to conventional rates in cases where lenders will not, exclude the bridge loan payment?
Sure. Generally speaking right now, on a good borrower, owner-occupied deal on the purchase, we're seeing stuff in the high 6s and low 7s. So I don't think the spread from non-QM to agency is that egregious at all at this point. And that excludes any of your LLPAs. For example, if it's a 2 to 4 unit, or a secondary home, not that that necessarily pertain to some of the bridge loans, but with that certain LLPAs, we might price better than some agency. So that you won't be selling a 999 first on the new house, for example.
Perfect, thank you. Let's see here. How will the deferred loan look on a borrower's credit report?
I don't know that these are even reported to credit, to be really honest with you. That's something that we'd have to look into on the bridge loans because they're short-term financing. We can check on that for you.
We got to send that person a prize. That was the first curveball question in a long time. So
I like that, yes, I like that one.
that's awesome.
Let's see here. Give me just a moment. Let's see this one. This particular question is, what's your EPO on the purchase loan? Do you charge EPO even or on borrower paid comp?
So we are a 6 payment EPO policy in general, and we do not claw back on borrower paid comp.
And we do not, what was that last one?
We do not claw back on borrower paid comp.
Okay,
or recapture borrower paid comp, to use a better term.
thank you so much. Is there an appraisal for the bridge or AVM?
Appraisal.
Okay, thank you. Let's see this one. What is the term on a bridge loan where max cash is at 70%? Is the bridge dependent on doing the new purchase loan with you?
So at 70% LTV, it is not dependent on us doing the new loan. So that can be a standalone product. And at 70, and this is why I'm glad Jackie's here, I want to say max loan size is 1.5 or 2 million.
At 70 LTV, we are actually at 70, we're at 1.5 million. We will do 65 up to 2 million.
And we do make exceptions to those case by case based on the scenario and the property.
Okay, these questions are great.
Yes.
Let me see this question. Can we get, let me see. Can we get set as clear expectations with our borrowers for turn time from application to closing table?
So we can absolutely help you with that. And what's really helpful for us is the more complete your initial submission, the faster the loan begins to move through the system, right? We get a more accurate underwrite on the loan. Certainly your response to conditions that we need and helping us receive documents will move the loan along faster. And as mentioned, we've closed loans actually in 7 or 8 days because we had a very cooperative broker that helped us get all the documents that we needed. So, but we do have highly trained account managers that will work directly with you and help you, to the extent that you need any help getting any of these documents in and understanding conditions. We try to provide really great service on that.
Thank you. Okay. When structuring the loan on our POS, do we omit the bridge payment?
You would omit the bridge payment, yes.
Yep.
Yes, you would. If in fact we are doing the acquiring property.
Okay, that makes sense. So if we're taking, okay. Let's see here. What does the listing status need to be on the departing residence? Just listed, under contract, etc. So
we recognize that some folks choose not to list their property right out of the gate because maybe they want to move out of the property and do a little bit of refresh on the departing residence. So we can make exceptions to where the borrower does not have to immediately list the property or does not have to be listed. Our guidelines say it does, but we will make exceptions in certain cases where they're wishing to refresh the property. Outside of that, the departing residence needs to be listed for sale. It does not need to be under contract.
Okay. Let's see here. There was a question statement that says purchaser may not be able to close on time for our borrower's closure. I think that might have been a follow-up to one of the questions that we've had. So let me go back up here. Will you allow a one-time principal reduction payment on the new loan, assuming you are doing the new loan as well? once the property sells and pays off the bridge without triggering an EPO for the whole loan, or that portion paid down, if that makes sense.
So contractually, it's if there is more than a 20% principal reduction on the loan, that triggers a recapture of premium if in fact it was lender paid premium.
And if it was borrower paid premium, Jackie, then it's a moot point, right?
Correct.
Okay. Let's see here. I think we're wrapped. These are great questions. So as Jamie mentioned, let's see here. Do you allow recasting on the new primary?
No, not at this time.
Okay. Let's see here. I think we're coming down to the last couple questions. So if anyone has any others, feel free to place those questions in there. Let me see. We'll give it a few moments. I think we might have enough questions that haven't been answered. So any other information, Jamie?
Sure.
You'd like to?
These were great. I mean, these were really great questions, detailed questions. It sounds like people really want to understand and utilize this product. So that's wonderful. If you do want to utilize this product, we have some private label marketing options that you can use. Here's an example where this is our BridgeStar flyer. If you have credentials, you can go right to our webpage, our portal, and log in with your credentials. If you pull up this flyer, your information will automatically be populated in the bottom of it. If you do not have credentials, reach out to your account executive to get credentials. If you need to get approved, reach out to us, we'll get you approved. But we will help you sell and market this loan and grow your business to originate more. We have this and other materials in there. Our account executives are very well versed in this product, so they can help you present this product to your realtors if you'd like, in conjunction with you. We will not do the retail loan, but we'll speak on your behalf on this product to help you grow your business to realtor groups and or boards. So please reach out if you want help with materials to market this product. And in summary, again, there'll be roughly 4.5 million homes sold in 2025. We do see the locked-in effect of low mortgage rates starting to subside as real life takes hold and people sometimes need to move. Originate More is all about providing non-traditional solutions to your borrowers and your referral sources so you can keep getting more business from them. Hope to partner with you on doing some more of this stuff. We do this webinar every month. We started back up this month. Next month, we have something pretty cool called Maximizing the Purchase Contract. There's really a bevy of leads in each purchase contract that people don't realize sometimes. So we hope you join us for that one as well. Tony, any lingering questions that we need to answer?
A couple that come up, I'll ask here. Well, what happens if the borrower ends up not selling the property?
Well, so if it is still listed for sale, the borrower can request an extension on the bridge loan, and we can look to grant the exception, assuming that it is listed for sale.
And now, okay. Let's see here. I'm just jotting this down here. Let's see. Now, this is a question that's a very legit question that both of you speak to, maybe Jackie as well, it speaks to our service, is how do we, as AHL, how do we differ from other lenders' products, such as Fly Home, Home Light, etc., if we know what can, maybe help share what differentiates us? Okay.
Yeah, we there's so many, not to sound overly salesy, but there's so many ways we differentiate ourselves. One is this call right here. There's really not many people out there doing a primary residence bridge loan. This is a unique, niche product that can help your clients as well as help get in the doors of realtors and originate more business. We touched on some of our other offerings, and again, we're glad to schedule another call to anybody on this to talk through our product menu. But when it comes to things like bank statements and variable expense factors and going below 15-20% on the expense factor, it can be huge in opening up qualified income. DSCR offerings from a low or no ratio up to a plus program. We have an 85 LTV DSCR ratio. We allow you to use the lease or the 1007 when beneficial with some guideline caveats. We have 3 months seasoning to use the appraised value on cash out. Loan amounts up to $4 million. Got a great 1099 product where it's just a flat 10% expense factor. We underwrite our own condos. So condo tells to 75 on DSCR, 85 condo tells on second home full doc. But we can pre-approve your condo projects for you. If you're in states like Florida where you've got insurance issues in your condos, like actual cash value on the roof or higher deductibles, Jackie and her team look at those every day and often approve them. So we can go on. And then we touched on fee stacking. Again, think of that deal we showed you where the broker was making 2.5 points on a good sized loan. And rather than have the client bring those 2.5 points to the closing table along with the down payment and the moving cost and the escrow accounts, the borrower in that case could finance the broker fee to alleviate down payment concerns. And there was no pricing to that. So we have so much that we can help differentiate us. Jackie touched on service. Jackie's team is one of the best in the business, we feel. Turn times generally in the 20-something day marks for non-QM. So glad to, we can stay on the call as long as you want, as long as you'll give us the time to. But, we can turn this right into a broker presentation if you want. So by all means, let's get in touch with the account executives or whoever and tell you some more.
And like one, it was just pointed out here is a question and so forth. A few people, including George was on here, it says that stacking is huge. And a few people have asked specifically more information on that. So where do we have more information? So just to answer some of the questions that were coming through is they are on our website. You can look at our TPO, ahlntpo.com under resources. And we have previous webinars that are listed on there as well as the PDF file that was discussed. We do have one there, stacking, that was talked about last year. And I just want to make sure, Jamie, in mentioning that the stacking webinar that we did on there was previous to having both of the programs. I believe it was just the one we had at the time. So yes, as you go through those resources, it's great to get familiar with it, but please be aware that we now have the 2 different loan programs, stacking tools, the realtor and the broker fees.
Here's a live example of stacking for the folks on the call. This is just, and you can go on to, if you have our portal in your credentials, you can go on and do anything in there really. You can go to AHL.com, go to the quick pricer, like Jackie said. Thank you, Jackie. You can dive right in there. But this is an ADLTV bank statement, primary purchase, just run-of-the-mill deal, 400K loan amount, 760 FICO, just a great borrower. We'll get some pricing. Green usually is good in our business. So, and you can see we've got a rate at ADLTV. So somebody asked about rates compared to conforming. There's a 30-year fix, 7.25 with a quarter credit to the borrower. So that's not a big spread over today's Fannie 30, I'm pretty sure. But let's look at stacking. So on this deal, again, the borrower is bringing $100,000 for down payment, escrows, reserves, title, etc. And let's say for easy math, for my sake, the broker wants to make 2.5 points, which is $10,000. What we're saying here is let's go and increase that loan size to 410. So now that borrower does not have to bring that $10,000 to the table. They can finance it if they so choose. And even though the pricing went to 82 LTV, when we rerun pricing, it should stay at 80. And I pull the pricing and it's different. And then everybody in the call says, what the heck, you just bait and switched us. So, and I have dry humor, so I apologize. So if you come up here, you see a little button, stacking fees. Just make sure that you click yes. We'll even give you a reminder, put your fees and loan amount. And now what you'll see is we all understand pricing buckets and LTVs on this call. Even though that is now 82 LTV, by clicking yes to stacking, when I rerun my pricing, I will be back down at the 80 LTV rate. So there is the beauty of stacking in one scenario. Borrower, if they so choose, did not have to bring the 10,000 to the table. The rate stayed at 80. And 45-day, by the way, folks, is our standard pricing. We have the best rate lock policy in non-QM. It's competitive with 30 to our competitors, but you have 45 days and one-time extension is available. So there's a great stacking example.
I have another question on stacking. As a matter of fact, it says when stacking LO comp, is that considered BPC? So insulated from EPO?
It can be, sure, yes. Most of our stacking comp is BPC, so in that case, technically, it is not part of EPO.
Okay.
Yep.
Let's see here if there's something stacking specifically. A couple more on the bridge. What's the maximum length that you can keep the bridge without asking for an extension?
12 months.
Okay. Let's see here. On this one, let's see here. They did this program with another lender a couple months ago, but now they're getting EPO even on a BPC. So that's a statement, but it's standard.
That could very well be the lender's policy. Our policy is on borrower paid comp, we do not claw back any borrower paid comp.
Okay. Let's see here. Is stacking allowed with a standalone new purchase first, or is this in conjunction with a bridge loan? Oh, good question. So is it stacking allowed with standalone new purchase?
Yes.
Or is this in conjunction with the bridge loan?
Oh, great question. We actually don't stack on the bridge. It's one of the few things we don't stack on, but the stacking piece is available on the new purchase.
On any of our loan programs, with a few exceptions that Jamie highlighted earlier.
Yep.
Okay. Let's see. Dave asked, yes, we will be sending out the recording to this. Absolutely. So you'll have an email with a link to the recording, as well as the PDF will be posted on our website. So we'll make sure that you have that as well. Let's see here. Somebody made a statement. Let's see. I think your non-QM purchase with fee stacking might be the winner, but thank you for that.
Thank you.
So yes, reach out for absolutely more information on that. Let's see, is there a hit to rate when stacking LO comp and realtor fees?
No, there's not. There's no adjustment to pricing.
Okay. Let's see, this one, I think that's it. Just a statement says it was their first session with us. Very informative. Thanks. Looking forward to next month's webinar. Oh, let's see here. Someone did ask, are we the only lender though that allows putting comp on top of the loan on a purchase for the same LTV pricing?
I know of one other that does it. I have to say, I don't believe they do it as well as we do. I think they charge. Last I knew, they did charge when they did that fee stacking, and probably systemically, if it's not set up properly like it is with us, it might get a little choppy in the background.
Let's see. The charge for the bridge comes out at closing, is that correct?
Yes.
Okay. Let's see. Anything else? I say that and then something else pops up, but let's see, can we stack discount points?
Yes. Yep. You can stack up to 3 points. Those 3 points can be used for broker fee and or discount and or realtor, and you could split it per the deal. So what I mean, Tony, is if you stack the full 3 points, theoretically you could pay the broker 2 points and use the other point to buy the rate down. So there's a lot of options that stacking opens up. You think of affordability. If you deal with real estate investors, imagine stacking the rate buy down and buying out the interest only adder. What's that do to open up their cash flow? There's a lot of options to stacking.
Is it available on refinance loans?
Absolutely. All of our 99% of our loans have stacking available.
Okay. Let's see this next question. Let's see, this one is, when would the next payment be due on a bridge? Let's say close mid-month, payment comes out 45 days later?
Mm-hmm. Correct. It's an interest-only payment.
But it's deferred.
It's deferred. So actually there is no payment. The borrower doesn't make any payments until the loan is paid off. because all of the payments are deferred.
Okay, thank you. Could be interesting. Let me see. Since it's could be interesting to finance buying down the rate.
Yes. Yep. It's a great option, you know, not just from qualifying, or if your DSCR is tight, or again, just whether it's folks want a lower payment or real estate investors want open cash flow. Stacking the rate buy down is really a nice feature.
And that is correct by saying by definition, refinancing fee is stacking.
Yes, you can. Absolutely. You can stack on a refi. It's going to give the borrower more cash out or cash in hand proceeds because you don't have to take the broker fee out of the cash out proceeds any longer.
Okay. Any others? I don't see any other questions. But like I said, we're going to make sure that we send the link for the recording. Give us a few moments. I honestly think it takes maybe a half hour for it to generate. We'll send that information out to everybody. We'll also let everybody know when the PDF file is available on our website, so you can review the PDF file with those specific examples. We'll also have somebody reach out to you. If you're not currently working with us with an account executive, we'll make sure that we still have somebody reach out to you with any questions that you've asked here or something in the future as well. And somebody was just asking, yes, if we can send an example of how the stacking fee is disclosed, etc. So we can certainly answer that question, provide those details, yes. And then they were just one thing to note is in our follow-up, Jamie, people are asking, understandably, to make the examples as detailed as possible, maybe to answer some of those unanswered questions that we might have.
Absolutely.
Okay. Let me see here. Okay. Well,
Great.
I do have to say, for most of the attendees have stuck through to the end, so we really appreciate the participation. It's kind of a learning experience for all of us. Jamie mentioned those are still on here. We'll have another one next month. We'll be sharing that link with everybody as well. So feel free to give us some feedback, and we'll be in touch with everybody. We appreciate your attendance. Thank you, Jackie. Thank you, Jamie.
Of course.
Thank you, Tony, and everyone.
Have a great day.